Hello and welcome to Switzer Investing Insights, brought to you by NabTrade. And today we're looking at the busiest week for reporting season, and we're going to look at two stocks that most of us own and two stocks many of us would like to own. Paul, let's kick off with Woolworths, eh?
Yeah, Woolworths, Peter, net profit up just over 12% to $1.72 billion, and group sales up 3.4%. For shareholders, a full year dividend of 103 cents. That included a special dividend of 10 cents, taking up 22.6%, so the final dividend for the year up 60 cents. Highlights, obviously Australian food, that's the really underlying Woolworths business in Australia, up 4.3%, and an improvement in their net margin, or their effectively their EBIT ratio improved by 23 basis points to 4.7%. So for every dollar of sales, they make 4.7 cents. Negatives, Big W is still a bit of a basket case, a loss of $110 million, down from $151 million loss the previous year. And the sales momentum in Australian food is slowing, only 3.1% in the fourth quarter compared to 4.3% for the full year, but also a slow start to the first 7 weeks of this year, partly brought on by the plastic bags, but also some promotions from Coles, only up 1.3%. So certainly Woolworths and Coles, in terms of the supermarket wars, that gap is starting to narrow. Bottom line, I think Woolworths is pretty fully priced. It's a multiple of something like 21 times FY19 earnings, low dividend, cannot get excited by Woolworths at this current price.
Well, I totally agree with you on Woolworths, Paul. Good company, but very, very fully priced. Let's go to BHP now.
Yeah, net profit down, but the underlying profit was actually up, Peter, and that's because of some write-offs with their US oil shale business. Full year dividend up 42% to 118 US cents with a final of 63 US cents. That was a little lower than perhaps some of the analysts had forecast. Highlights in 2018, volumes up 8%. Some productivity momentum in the second half, although that's getting a bit trickier. And the free cash flow generation, really positive. Net debt down to just $10.9 billion. Negatives, well, it really wasn't a beat. It came on pretty much as expectations. And in terms of looking ahead for the next 12 months, BHP is actually forecasting reasonably flat volumes for the next 12 months. Bottom line, I think you stay BHP because it's the best way to play the commodity uptrend. That's still in place. And secondly, shareholders can look forward to a big capital return sometime in the next 12 months. BHP's announced that it's sold its US onshore oil assets for US $10.8 billion. Most of that's going to come back to shareholders, and we hope some of that will come back through an off-market share market buyback.
It's funny, Paul, I was thinking about selling my BHP shares. I bought them around the $15 mark. But I thought, well, hang on, the analysts think it can go 10% higher. And one analyst from Shaw Stockbroking got it at $40. And I thought to myself, I want to get this special dividend when they pay it out. If I sell now, I might miss out, and I'd be really... And a lot of people will be thinking the same thing.
Yeah, I think unless you're really bearish about commodities, I think you stay long BHP because this return is going to be huge. And I think that's going to provide solid support for BHP. But look, would I be buying now at the moment? Maybe not. No. But look, I'm like you. I've been long since $15, and I think you just stay long and play with the trend still.
Exactly. Let's go to A2 Milk now, Paul.
Yeah, we selected A2 Milk because this is one of the so-called growth companies, and some of these stocks have been trading on pretty high multiples. So A2 Milk was one of the first to report. NPAT's up 116%, which is a little better than estimates, to $195.7 million, and earnings per share of 27 cents. That compares with estimates of around 26.1%. Revenue, strong growth, 68%. And in terms of looking ahead, despite some cost pressures, they expect their EBITDA to sales ratio in FY19 to be broadly consistent with the last year. That's actually a positive because the market's been concerned about cost pressures in their business. The negatives, well, they didn't actually put a number in terms of what they're expecting for the next 12 months, but they guided to further growth, whatever that means. I think for a stock that's sort of gone a lot higher, come back a bit as people have factored in more risk in China and perhaps regulatory risk, I think it's now not priced. It's priced quite reasonably. So I think the market overall, when it digests this results, will probably say there's a bit of value in A2 Milk.
I tend to agree with you, Paul. A2 Milk's a great company, and it's proven it over the last few years. There are still some risks there, so I wouldn't be going heavily exposed to it. But if you missed out before, it's a good stock to buy in the dips.
Yeah, I mean, there's been some concerns. Obviously, we've got multinationals like Nestle sort of nudging into the same market. Concerns that A2 milk might have some of its market share eroded. But look, I think it's a pretty good result, and there's a good team in place. So this stock has come down into the result. I think there's a bit more upside in A2 milk.
It's also a takeover target too, Paul, when you think about it. Okay, let's go to WiseTech Global, WTC.
Yeah, this has been trading on a massive model. This is probably our equivalent of we've been really, the tech stocks here locally have been caught up by what's going on in the US. So this is an important result. Look, it's largely delivered on its on the forecasts. NPAT up 28% to $40.8 million, and net EBITDA up 45%, and revenue up 44%. Full year dividend of 2.7 cents per share. In terms of looking ahead for FY19, revenue growth of 42 to 47%. That's about the same range as was achieved in 2018. And EBITDA growth of 28% to 35%. The 35% is probably what the analysts were looking for. But look, bottom line, this stock is trading on a multiple of circa 85 times FY19 earnings. Look, when you've got EBITDA growth of just 28 to 35%, I can't see why a stock's on 85 times earnings. I'm not a buyer, Peter. For me, this is in sell territory.
Let's sum up what you've seen so far then.
Yeah, so let's start with some information from AMP Capital and Shane Oliver. So you can see that on the screen in front of you, where we've had the more surprises than normal. So an 83% reporting higher or dividends, profits, and 89% increasing or holding dividends steady. So on the dividend side, it looks pretty good. Earnings are on track for about a 9% increase. Now, of course, it tends to be that some of the weaker reports come towards the end of the season, so those numbers could come down a little bit. But I think overall, it's not too bad. It's not shooting the lights out, but there haven't been too many really bad disasters, and there haven't been too many really big surprises. So on the screen in front of you also, you can see some positives and some negatives. And there aren't too many in the negative column, Peter.
No, exactly right. I think all up, the stock market's resembling the economy. It's getting better. It's not great. It's good, but it's heading in the right direction. That's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.